Right, good day to you all traders. I've created a new topic. It's called market cycles, and this is about the accumulation and distribution process. So, the very key part of this is also to understand the market psychology. And of course, this is where I'll bring in some of the charts and examples on what is happening on each part of the price action. It doesn't matter if you're an investor or a trader. So if you're an active investor, this will be very important for you. And if you're an active trader, day trader or swing trader, it will be even more important for you. All right. So now let's get started by going to one of these chart pattern. Now, if we talk about the market cycles, and this is the chart where I created for investors. And most of the time, if we look at the yellow color part, and that is the part where this part, this is the part where most of the public retail investors do not know. And well, most people would not actually accumulate or actually buy into those positions. And now the first reason is why. Now, in the yellow part is that most of the time it's below the moving average. So when we talk about prices below moving average, is that let's say if you have price trending down below the moving average, let's say this is your moving average, and if price is trending down there, normally investors would not buy. All right, retail investors would wait for the price to break up, and both, let's say if they have a slow moving average and fast moving average crossing above. All right, and that's where they buy after the moving averages crossover. The slow crosses the fast moving average crosses the slow moving average. And then when they see that crossover, the investors would come in to buy because that is the safest zone. Because if they actually buy when prices are below the moving average, there is always a possibility where price could go even lower. All right, it's not the safest time for them to enter, especially for momentum investors. They will want to see a price that actually goes above the moving average, and both of the moving averages are sloping upwards, and there's a crossover before that, right? So that crossover is always what I call a golden cross. So they always want to avoid the risk, but this is the best time for since they are not buying. It's either they're selling or they're selling or they are not doing anything, and this is where traders would trade into the sideway patterns, and professional investors, which we call them the VIPs, because let's say if we have a huge discount seasons in any place during the holidays, discount season comes, there will always be a day before the public knows that there's a discount coming. So they are like the VIPs that goes into the discount shops to buy their items first before anyone rush in and buy later, right? So they'll be the first one who gets the best price, and they have huge positions, and when they buy millions of shares, and most of the time in the yellow part it would last up to from 6 months to even a few years. So typically I've seen accumulation processes that last most of the time 1.5 years before they send the price up. So right, so since we know it's moving in a negative flow, and this is where, for people who wanted to accumulate millions of shares, just imagine if they actually execute that in one go, what would happen to the price? Let's say, for instance, there's always a big problem with slippage if they do that. So let's say if this is your intended buying price, and in the market is the last done price is trading around $10 per share. And the thing is that let's say if you have 300 million shares to actually buy, if you buy it in the same day, And let's say, for instance, most of the sellers, they want to sell it at higher price. Let's say they want to sell it at 20 US dollar per share. Now, if you want to execute about 300 million dollars worth of shares, will you actually get it at 10 US dollar in the same day? No, the answer is actually no. It's very difficult for you to actually, to get that kind of price when you execute $300 million for a share. So what happens is that you would get, when most of the sellers are up here, what you get is that your last done price would be up here. The whole price action will be shot up here or even higher depending on the volume of the stock. All right. So this is what we call slippage. All right. Executing a big volume of amount of volume at market price. Right. So now, if they want to avoid that problem, is most of the time what they do is that they would wait for the price to come into their anticipated price. So let's say the market is still, when this thing is the price is in negative flow, then market will still keep on selling. Public will keep on selling, and they would wait at low levels so they could get the best price at this time. And they do it very subtly, because if they execute very huge volume, then it will cause the price to spike up, and the public would be aware of that, and people will be rushing in to buy, and they will be left with a half done position. If they want to accumulate 100 million shares, they probably they got in half. Then the half afterwards they will have to battle with other retail investors. So, well, of course, when they do this very subtly, it takes a long time. And it is like accumulation stage is like storing up a lot of energy, compressed energy at a time. And when they do this, they have to do it below a certain price level so that the market does not actually notice that. So once they have accumulated enough, and now this is the time where they hit the go button, and they say, "Hey, going to the green zone." They say, "Let's actually allow the public to take the price up," and this is where they actually do a momentum trigger in the red color circle part. All right. Sometimes we could see bear traps when they do that. They would invite even more short sellers to come in before they finally send the price up. You would see a shooting star. You would see bearish ice cream candles near the dotted lines resistance area, and they do a short squeeze on that. And what happens is that the short squeeze, short sellers are actually later part were forced to join into the buying momentum in the later part. All right. So now the green color area is where most of the seasoned traders or breakout traders, they come into the trade and they buy, because this is where they see the price action is actually moving above the moving average, and they notice it's in the positive flow. And as a price, they start to do some correction, and this is where they actually take the price higher and higher. So well, when they do that, and it starts forming some uptrend patterns, and as the patterns go develops into the later part, when it comes into this orange area, and this is where most of the public, most of the retail investors starts to notice that the price uh, it's really trending, and they feel that they do not want to miss out this action, and they buy into this trend. As the price goes slightly lower, then they start to buy into the trend, or some don't even wait for the price to go lower. They would actually buy, even at chase the price as it goes up. Of course, the more patient ones would actually wait around these areas, correction areas. But of course, nevertheless, the price swings as it trends further. Then the price swings becomes bigger, and it gets to a point where we call this point here, which we call the maximum euphoria. And this is always the point where a lot of retail investors will start to buy in as the trend becomes more obvious to everyone. So when it becomes more obvious to everyone, that means the professional investors who has accumulated around these areas, they have a very huge gain when the price comes up to this area. And this is the best, this part is always the best opportunity for them to unload whichever they have accumulated right here. So let's say they stored a lot of energy right here, and this is the area where they would release a lot of the energy where they have stored for a long time. So most of the time, the public is the ones that are actually giving them the opportunity to come out from the trade right here. And if you notice this, normally these are the areas that I avoid buying. Um, I mean, I would buy around this area when they finally release. Not release the energy. Finally, they trigger the momentum. All right, so that I don't have to wait long. If I'm a fundamental investors. I knew that this stock is a very good fundamentally, and I keep it in my watch list. If it breaks up from what we call, this is called a rounding bottom, and then this is the time for me to get into the trade to actually ride the momentum all the way to the upwards. All right, so but there are times that I would buy around this area. All right, it depends on the price action. If there's within this rounding bottom, if there's a double bottom right here, then I would buy into the double bottom right within the rounding bottom. All right, but of course, in this topic, I will not actually cover that. I will cover that in the next video, or some other videos, because it's too much to talk about on that. And let's say now there's always a saying that bull markets die on maximum euphoria. All right. So, and bull markets are born at maximum fear. So that's why a lot of professional investors they go by these principles, and they play by different rules. And this is where they store up the energy, and it gets to be released over here. All right. So I may repeat this a few more times so that you could remember more easily. And this concept also, when we look into greater details, that we know that when price actions becomes parabolic, exponentially increasing up move, which is around 90-degree upwards, and this is the time where I would sell my stock. And when if I don't sell here, the next thing we know is that any moves that goes up in parabolic would actually comes down in parabolic. So they would always call it the return of parabola. All right. So now as price move on, and what we can see is that right here, as the price goes a bit lower, and more euphoria comes in, and the public starts to come in, and let's say if you are the professional investors, if you have not unloaded all, you have unloaded probably 50% at this top here, then this is the best. I mean, this is a good chance for them to also release another 50% in two stages, different stages. All right, and of course, this is also very, if there's even more euphoria here, not just unloading, the professional investors or professional traders would actually turn their trade around to take the price down on the later part. And also, when I see a huge, when a steep flush up here, and if the price closes back within this resistance, and this is the time where I like to go short. And of course, as price develops, and this area where we call it the distribution phase, it did not manage to make higher lows. And of course, when the price starts to come back to this low, and it forms some sort of a support, and that's the final touch on the price, is where this is because the price is still above the moving average. Most of the retail investors would think that this is still in a positive flow, and it's still time to buy, and they would buy in here where the support is actually converging with the moving average. And most of the time, I would not buy over here. I would call this a bull trap, because most of the time retail investors will get caught in this area, and this is where It is a final redistribution phase at this area, this green color area, where you would see a hammer, um, a pin bar, sorry, a bullish pin bar at this area where it would invite a lot of retail traders thinking that the price will continue to go up. Because because right at this area, let's say before the price starts to swing down here, as the price was forming at these areas, sorry, then their thought is that the price would continue to go upwards. All right. So of course, when the price moves below the moving average and it breaks below the support, all right, and it moves into the pessimism phase. And well, depending on the stock type, if this is a very strong fundamental stock and after the pessimism stage, I would look for signs of reversals to actually accumulate it. I mean, to accumulate this stock at a lower price as it forms some reversal patterns in the later part, because the cycle in each of these products will start to repeat again and again. There will always be this accumulation and distribution cycle. So I mean, understanding the psychology is very important, and not doing what the public, the public or the retail investors are doing mostly. I mean, that keeps us away in trouble. I mean, keeps us away from trouble. Right. So let's move on to some examples. Let's say for this stock, Apple, and when you look at the price action, is that you can see after a markdown phase, then they start to initiate the accumulation phase. And this accumulation phase took them around 1.5 years before they start to do a momentum trigger right here. This candle, there's a momentum trigger candle, and price starts to trend upwards. And this one was a bit early. The golden cross was here, and as the price keeps testing the moving averages, and the market notices the bounce, there was a strong bounce, and the price is still above the moving average. As the trend forms in this area, then the trend has become very obvious. And what happens next is that the price becomes parabolic. And this is where the most retail investors starts to buy into this price. And of course, those who have accumulated around these areas, the professional investors, at probably 100 USD per share around. And at this area, with the euphoria that's bringing this price up to 230, and this is just for around 2 years to actually gain from 100 to 230. So that's more than 150% gain in the portfolio within 2 years. That's quite a lot. Very handsome profit. So this is the best area where they could take their profit. And you notice after that, the seasoned traders would notice there's a lot of profit taking around these areas because price has been has been very volatile over there, choppy. There's a lot of bulls and bears fighting over there. Finally, the bulls give up and the price starts to slam down, right? And of course, from there, then we would anticipate the pessimism phase or the markdown phase, right? Okay, this is pretty fast, and this is Alibaba, and Alibaba took them around 2 years to accumulate in a very subtle manner. Then the red color or the pink color circle is where they trigger the momentum, and it's just very short. The markup phase is very short. I think once this is very actually very obvious to the public that this is where they could buy, and once they buy that, this whole thing can become very parabolic because what you can see is that this is overstretched from the long-term moving average. And this one actually this price action actually indicates that there's a lot of retail traders jumping into the trade or investors jumping into the trade, and it creates a lot of euphoria, and this is where they professional investors will start to unload, and you can see that it creates a lot of volatility right here. And finally, see it forms some, because there's a support right here, and this is the area that I would always want to avoid buying into this pattern. If there's a hammer or a bullish pin bar here, or engulfing any bullish pattern right here that's presented, I would not buy, because the first thing is that what I know is that the psychology is that those who have accumulated right here will be taking advantage of the markup stage that's generated by the public. They would actually want to get out around these areas. So from the choppy price action, I would end the waves down. It would seem that this is actually not a great area to buy. Now, of course, talking in retrospect is easy, and if you're trading in real life, it's a lot more difficult. So that's why we would have to see a lot more examples to actually, do more practice, and more recognition before we trade into different stocks and patterns. Right. So Micron United, another stock that is this is a major manufacturer in memory chip. So the accumulation phase took them about 1.5 years to accumulate, and finally they did some, but it seems that there is some reaccumulation right here, and some reaccumulation right here. Now what you can see is that price action, the candles here are very small during accumulation phase. It's like there's no interest in buying from the market, and it's below the moving averages. So there was no interest in buying, and the retail investors would stay out from buying here. So they would even sell as the moving average, as the price touches the moving averages, right? And professional investors would put their buy limit over there to take up the orders. And once they take up enough of the orders, then you could see price slowly drifts up to above the moving average, and finally there's a golden cross right here, and they notice that the price starts to break out from this rounding bottom, and you can see the candle starts to gradually become bigger as the price goes on, and the swings become even bigger as it goes further up. So as finally it reaches up to this euphoria stage, and this is also a very good time for the retail, for the professional investors to actually unload their positions. So they've accumulated around 10 US dollar per share, all right at this area. And at this area, that unloading is about 60 to 65 US dollar per share. It gave them a good opportunity to get up on trade, and possibly even to reverse the trade from here, given enough volume. So because there was two parabolic move upwards, and this is where they could even reverse the trade when there are more volumes to take the price down and reverse their positions in the later part. All right, or cover their shorts. So, well, I would say from 10 to 60 US dollar, and this is done within about 2 or 3 years. It's a pretty nice profit, almost about 600% gain. So, all right, now this is what I've always been mentioning. It always repeats, and not in all stocks, if you buy here, then it would have a very low probability, and even the prices here, it's already below the moving average. All right, so this is where I would avoid buying after it forms this hammer. All right, so I often call that a bull trap. Even if the price goes up, I'm okay with it after that. And what you can see is that people would always think that when the price keeps testing the moving average, it keeps bouncing at the moving average, and when it becomes so clear to everyone, and this is the last one as it bounces off there, and a lot of people notice because there's a lot of bounces, 1, 2, and 3, and this is where the best time for professional investors to unload. And Yeah, still they managed to try to bounce once over here, but it didn't go up. Bounce another time over here, didn't go up. And this is also another bull trap right here. Right, then price, the bulls finally give up, and the price starts to go down because there was not enough bullish volume. Right. So next, Lam Research. This is also 1.5 years. Like I said, I see most of the accumulation in strong fundamental stocks lasts up to 1.5 years, typically. And because I think with strong fundamental stocks, there will be more participants in the market to allow them to accumulate in a shorter period of time. So now, same price behaviors, if you look into detail, is that the candles here are very small, as it is actually, there's some flush down as the some retail investors were buying right here, but not a big percentage, and there's some flush down to take them out. All right, go up, flush down. So forms a resistance where they couldn't take a profit. They were in the trade, but they were stop out. All right, the professional traders were actually taking them out, taking the stop losses out to accumulate from, because their stop losses, the retail investors who are buying in these areas, their stop losses are sell orders. So during accumulation phase, the professional traders or professional investors, they would need to collect sell orders. They will either wait at a very low level with buy limits, or they flush the prices down to induce fear and panic in order for the retail investors to sell out their positions, because they are always standing, they are always on the other side of their trades, of the retail investors trade. Right, so finally they did a momentum trigger, still small candles right here, because it's just the seasoned traders who knew breakout, who are more trained to look at price action. They knew that this is a breakout pattern, and they start to buy in here. And of course, as the trend goes, further, develops this part, this is where, most of the people knows that, okay, it's really trending, and this is where the swings become a lot bigger, and finally another parabolic up move, and this is where again professional investors will start to unload their positions, and it creates a lot of volatility right here. And finally, there's a bull trap right here, and a death cross bull trap right here, and this is where bullish players starts to give up, and as price travels down, and this is where it hits a lot of stop losses of the bullish players, and when generates a lot of momentum downwards. Right. So what we have done previously is that those are the accumulation. I mean, these are actually more for active investors who care about price actions to lock in more profits. Now, because if you look at the passive investors, when they're investing, most of the time they're looking about into 15 to 20 over years of investing, and they will just look at the fundamentals without caring about prices. But not many people who can hold on, 15 to 20 over years in their investment, and knowing price actions, you could benefit cycles are more in a more optimum way, that you could actually lock in more profits in this kind of cycles, where you can you could sell and pick up at a lower price later. So, all right, Cofus is a lot of more work, a lot of work compared to passive investors if you're active investors, because you would need to study all these price actions to do it. Right. So now coming to more, people who wants to be more active and to have even more profits in a short amount of time. All right, but don't get mistaken that this is a get rich quick scheme. Most traders they would actually realistic traders, they would believe into actually getting rich slowly. All right, if you believe in the power of compounding. All right, if you're in a mindset of getting rich quickly, then you would be approaching the market with a very aggressive mindset, and you would actually go into a lot of wrong and invalid trades. So for you to become a good trader, the first thing is that to actually approach the market in a very defensive way. Always look for a reason not to trade. Look for the flaws in the price action. If the price, go for quality. And what I mean is that go for quality trades, not quantity trades. Because a lot of traders, when they get into the markets, they like to see a lot of actions. They like to do a lot of things, so that they could get to get the bank's account to be actually fatten up faster. But actually, if they do that in an aggressive manner, most of the time they'll find themselves not consistent, right? So psychology is the utmost most important, not just the knowledge. So, all right, the concept in this market structure, it's more or less the same that I show the models that I show investors. And I would say you have to pay a lot more attention into the price angles. And what you want to do is that you want to trade into the positive flow and the negative flows as well, like what we have shown in the investors market structure. So like what I said earlier, if you see a fast moving average crossing the slow moving average upwards and both of them sloping up, so that crossover is what we call golden cross. And after that, the traders would look into trading the price upwards, because this actually provides, they will say that this is a positive flow if the prices are above the moving average. All right. So same if the fast moving average crosses below the long term moving average, and that is called the negative flow. Right. So and after the death cross, most traders will want to take the price on the bearish side. Okay, so now if you're on the left hand side of this chart as price, let's say price has been trending downwards, and this is where if you're a trader and you want to buy at the lowest price of the possible, the most optimum price is to look for bear traps when there are early reversal signs. So this is the sign of reversal. This is also a sign of reversal, but that's where I don't buy in. Because after a long markdown stage, and this is after markdown stage, this is where we look into accumulation stage, and it doesn't come with rounding bottom all the time. Now this is a different combination. We have a double bottom right here, and this seems to be more aggressive, and it happens in smaller time frame. All right, and this could happen in a single day. This accumulation structure. This double bottom. It could happen in a single day that it forms and it sends the price up later part. And then this whole structure here for a 30 minutes chart, especially in futures, would last for 1 week. Doesn't matter if you trade indices or gold, silver, crude oil, all right, or even currencies. This models is meant for that day trading or even 4 hours swing trading. Right, now let's get back to this double bottom. So what you want to see is that you want to see that the price has made a temporary break right here at this area, a temporary break that it actually gives the impression that the price is breaking downwards, and a lot of short sellers are coming into this area and they start selling. But what happens if they start selling? Then the professional traders are waiting at these areas to accumulate these sell orders. And even for those who have bought earlier, right here, as they see some early signs here, they would have their stop losses right here. So this this structure right here, this shakeout this shakeout price action, which is very sharp, causes a lot of fear for those who have bought over here, and actually it hunts their stop losses. So their stop losses are also sell orders. So this is where they accumulate the most of the sell orders before sending the price upwards. Right. So and I would say that this is my favorite price pattern. Most of the traders, they would wait for the price to break the neckline, and after the price has crossed after the moving averages have crossed, then they'll start to buy. They either buy over here or they buy when consolidation breaks up here. All right. which is not so optimum. If they buy over here, they would have their stop loss here. If they buy over here, they would have their stop loss over here, right? So I would buy. For me, I would for this one, I would buy over here. Then my stop loss is right here. All right, I could actually hold on to the trade for 1 or 2 days even until up around this area. And for this one, I would buy around this area, then to wait for the price to go up in this area. Okay, so if you're looking to go long, look at the bad traps, and bad traps are very important for ultimate entry. And if you're looking to go short, you can go short before the moving averages crosses below. I mean, the fast moving average crosses below the slow moving average before the left cross. What you could see is that most people would call that double top. Uh, and the best area to sell is actually to sell around this area. And after the left cross, if we see consolidation, the best part is to sell when the price starts to test, looks like it's going to break the moving average and continues to go up. And this is where most of the bullish traders would start to take the position into this part to buy into the price action right here with their stop losses around this area. So if the price fails to go up and starts to close back in, and this is where I will sell. And of course, as the price goes down, then this is where it creates a lot of momentum downwards, because the bullish traders, when they take up a bullish trade up here, they will have their stop losses right here, which is sell orders. Right. So if you're a trader, price action is very essential to you. And by looking at both moving average and naked price action, it would actually give you the first-hand info to actually start to short, when to short, where to short, what to avoid. And when before I short at this part, I would really want to see this structure. Most part of this structure is above the long-term, or the slow-moving average. All right, as you can see, even the market starts to attempt to take the price higher at this point when it tests the fast-moving average. So this is where they get caught on the wrong side. So, and also when this is happening, I want to see a long overstretch price action over here. All right, so it's like it has done 100-meter sprint over here, and it's hard for them to break out even further away from this price action. And moving averages are like gravity. The higher you go, the harder you fall. All right. So same as the bottom part, it tends. It's also like a rubber band, not just like gravity. As price starts to travel all the way far below here, it's overextended, and it starts to actually retract back near to the moving average on the later part if it overextends. So I avoid selling at this part because it's too far away. And this is the best part to go long for me. This part, when it closes back above the support level. All right, so let's go to okay, so I've circled some of the red areas where you want to go short. All right, so now this price action is not just for day traders. And if you have a very cyclical stock, service sectors and commodity related stocks or deep cyclical stocks, and you could apply this same concept. And you could see a lot of bear traps and bull traps. Usually, the bear traps and bull traps would be forming. You see, what you can see is that if you look into detail, it often happens. Let's say this bull trap right here, you want to trade, you want to go short right here. So what you would anticipate is that the price action has done some parabolic up move, and price is testing at this fast moving average, right? And it's done some parabolic, very sharp move upwards, and like it's going to make an impression like it's going to close above this area, and price continues to go up. And this is the area where most bullish traders would start to get trapped over here. Like someone would buy into the retracement right here. So as they would buy right here, professional traders would always want to be at the opposite side of their trade So that's where the sell limits of the professional traders are. And of course, this would, when the price is stretched so far up, it would give them a lot of space to profit before hitting the next support level. And if you look at the price action over here, you can see it's very far away from the moving average. This is one of the characters that you should look at. And this is what I really look at whenever I was short whenever I was short these prices, then I would want to see it's very far away from the moving average. It's like a rubber band pulling it back into the or even through the moving average on the later part. Okay, and of course, once the price crosses below here and it's moving in negative flow, and if there's a flush up, slight flush up, and this creates like an impression price is going to continue upwards, and this is where the bullish player starts to get caught into the play. All right, professional traders, they'll start to sell over here at the highest point of liquidity. So this is one of the stock futures. This is the Dow Jones futures, and this is what most people will call a rectangle. It's formed some rectangle. What we want to see is that during accumulation phase, I would want to see a lot of price action moves up around 45-degree angle, and it starts to be hammered down in the almost 90-degree angle, and it reinitiates a 45-degree angle upwards, then some flush downs, upwards, flush down, and finally it tries to break downwards this part, giving an impression that price would continue to go down. But of course, there's a lot of buy limits order here from the professional traders to keep the short sellers from taking their profit right here, keeping them in the trade, so that they could actually close the price back upwards to actually borrow their momentum. The short sellers' stop losses will be here to borrow their momentum to actually take the price upwards later, or to force the short sellers right here to join the here. When it hits their stop losses are actually buy orders, automatic buy orders. All right, when they get, then when price touches their stop losses, it will trigger a high momentum upwards. Or there's a lot of stop losses here. So for those who have went short over here, they probably place a lot of stop losses here, and you can see a huge price upwards. And when there's a parabolic up move, this is also where most of the professional traders will start to take their profit, right? Okay, more examples. All right, if I want to go short, like I said, I would want to see, after a long markup phase, I would want to see price going into moving up parabolic behavior. This one, a lot of parabolic behavior, and there's some distribution right here, but it's not too distinctive. And price is waving downwards, and what I want to see is that a 90-degree move up here before I start shorting. When price closes back inside here, and this is where I start shorting. So same as this one, as price starts to wave down a little bit, and there's a parabolic move upwards. Right, so same concept in shorting. And next year, I'm planning to launch a book. It's called The Art of Modern Investing and Trading. So what it'll actually consists of a lot of visual graphics that states the different type of sectors and behaviors, and what you can actually trade or invest. And I'll include some fundamental details inside what I actually look for in a stock. And there'll be a lot of statistics and behavior studies into different kind of sectors, and whether it is a defensive stock or deep cyclical stocks, what are the pros and cons in that. All right, so I also compare them with the indices what happens during subprime, when subprime crashes, what kind of stocks you can't invest, and some of the stocks they did not businesses they did not recover, and the stock stayed down for a long time, right? So Okay, I hope you have enjoyed this video and happy trading and investing. I'll talk to you the next time. Thanks for your time.